Derrick Smith here, senior trader at T3 Trading Group with your pro trading tip. Today I'm going to be talking about how to utilize moving averages in trading appropriately. The biggest, most common mistake I see and I hear from people who are getting involved in trading is they think that moving averages are support or resistance. Moving averages are just averages. They're just little squiggly lines in your chart that are composed of the average of the last however many bars, depending on how far out you're looking at the moving average. For example, a 20 simple moving average is the average of the last 20 candles, 20 periods on the time frame in which you are looking at. So all it is a line that's a math line that's created by an average, right? Very simple. So this is not support or resistance, but they can be powerful tools if you use them correctly. For my own trading, I look at an 8 and 21 EMA, and I also look at 20, 50, and 200 SMAs, particularly on larger time frames for those simple moving averages for my own trading. Let me explain to you how I utilize them. So first of all, the 8 and 21 EMA is a really important tool for me for my own trading. Again, not support and resistance. The way that I utilize an 8 and 21 EMA is the space between those moving averages on any chart that I'm looking at is the space that represents what I call technical equilibrium for the marketplace. If I'm looking at a stock or a market and it has moved very far away from its 8 and 21 EMA, that is a stock or a market that I would consider to be extended from equilibrium. And understanding extension in markets is really important, because if I'm buying a stock that's extended, it means that I'm going to have a worse risk reward and a lower probability of success on my trading. So I can also learn to utilize this 8 and 21 EMA tool to have a better idea of where I expect a stock might create a lower high, as an example, a new pivot point to continue a trend, or I just understand, all right, this stock here is really extended because a lot of momentum came in. I should be patient. Maybe a bull flag comes in, which would be more of a time correction that allows those moving averages to catch up. And now that the moving average caught up to price, I have a better potential opportunity in front of me with a better risk reward and probability of success. Next, the simple moving averages that I mentioned, the 20, the 50, and the 200 SMA, simple moving average. I specifically like to use those moving averages on larger time frame charts, daily and weekly charts. And for me, the most important part about those moving averages is actually the slope of the moving average itself. Is the moving average pointed higher, sideways, or pointed lower? Are those moving averages crisscrossing each other, or are they all telling me the exact same thing with like a rising 20 simple moving average above a rising 50 simple moving average above a rising 200 simple moving average? So the simple moving averages, their slope tells me the essence of the trend for that time frame. So if I'm looking at a daily chart, a 20 SMA on a daily chart, well, how many trading days are there in a typical month? About 20 on average. So if I'm looking at a 20 SMA on a daily chart, the direction of the slope of that moving average will tell me the essence of the trend over the course of that last month. Whereas the 50 simple moving average is going to be more like a quarter. So I call that my intermediate time frame. I'm looking at that daily chart, I see the slope of the 50 simple moving average. Now I have an understanding of the essence of trend going back for the last quarter. 200 SMA is about a year. Really important moving average. It's going to represent the long-term essence of trend for any stock or any market that I'm looking at. So now that we understand these time frame differences, a month, a quarter, a year, we know that if I'm, to go back to the example I was using before, if I'm looking at a rising 200 and above that is a rising 50 and above that is a rising 20, I know the essence of trend for every time frame I'm looking at. 1 year, 1 quarter, 1 month is all the same. It's all higher. So that means if I'm going long that stock or that market, I would have a higher probability of success than if I was looking at a stock that had them all sloping down or intertwining and going sideways and going nowhere. The key with these moving averages that people need to understand is that they are not support and resistance levels. They are tools. And if you can learn to utilize those tools, it can be very powerful for your trading and very powerful for understanding risk, reward, and probability of success for any trades that you actually take. If you like what you learned today and you want to learn more, first of all, make sure you click on that like button, make sure to subscribe below, and also click on the link below if you want to learn more about how you can become a part of my team through the Pro Desk virtual trading floor at T3 Live, or how you could potentially one day become a professional trader with T3 Trading Group.